Hey, in this video, I'm going to talk about the IRA contribution for 2021. The deadline for you to make the contribution for 2021 is April 18, 2022. Right now is in February 2022, so you still have the time to make the contribution to our traditional IRA. So in this video, I'm going to talk about if your contribution is tax deductible or not. So you can make a wise decision should you make the contribution. So first of all, we want to know how much can you contribute for 2021. See, if you earned more than $6,000 or $7,000, I'm going to talk about why is the two number here. In 2021, you can contribute to a traditional IRA up to $6,000 if you are younger than age 50, $7,000 if you are age 50 or older. So first of all, you have to have a job. Then you have to have a job income. If your job income, if you only had a part-time job, you only made a $3,000 last year, you only can contribute maximum $3,000 to your traditional IRA. So you have to make more than this amount. So in order to contribute the maximum amount, so you can see the maximum amount is $6,000 if you are younger than age 50, $7,000 if you are age 50 or older. So this is a maximum you can contribute. Of course, as long as you not contribute more than maximum, do not contribute more than maximum because there's a penalty for over contribute. If you make $10,000 contribution, then you only allow for $6,000. So your $4,000 will be over contribute, called excess contribution. You will be have a 6% penalty on the over contribute every year until you take this $4,000 out of your account. So that's just something. Be careful. This is maximum you are allowed. Of course, you can contribute $500 or $1,000 or $2,000 to your account, if you don't want to contribute the maximum. So that's just something you need to know how much you can contribute for 2021. Okay, next we want to know, is your contribution tax deductible? Yes, not all your contribution is tax deductible, so that's just something you need to know. So the situation is a little complicated based on if you have a retirement plan at a workplace or not. So first question you want to ask is, are you covered by a retirement plan like 401k at the workplace? So basically, if you work for a company, they usually offer you a retirement plan. Most common is 401k, but many others like 403b, 457. Then you also have SEP IRA, simple IRA. Those are called workplace retirement. If you are covered by those workplace retirement, your contribution may be deductible. But here, if you are not covered by those workplace retirement, the answer said you are not covered, right? Then yes, your contribution is fully deductible. This doesn't matter how much you make. You make $1 million, $2 million, you can make a contribution maximum $6,000 or $7,000 to your traditional IRA. You can deduct the tax. So that's if you are not covered by a retirement account at your workplace. So just a quick example here. Say Mike is married and made $150,000 in 2021, but his workplace doesn't offer any retirement plan. You can see here Mike is not covered at the workplace. So he make $150,000, so he doesn't need to worry about if he make contribution, he can deduct the contribution. Another situation, he is married. His wife is a stay-at-home mom, did not work in 2021. They both under age 50. So in this situation, both Mike and his wife actually can make a contribution to their traditional IRA. Remember, retirement account is individual. So each individual, you have to have your own individual account. So Mike has his own traditional IRA. His wife can open her own traditional IRA. So Mike can make a maximum $6,000 contribution to his traditional IRA, and his wife can make a contribution to her own traditional IRA. So the total is $12,000 contribution. So if they married file jointly, if their marginal tax rate is 32%, you can see the marginal tax rate if 32%, then both their contribution, which is $12,000, are tax deductible. What does tax deductible means? You do not pay tax on this $12,000. So if your marginal tax rate is 32%, so they're gonna save $3,840 taxes. So that's how you reduce your tax bill, right? So another benefit is if they make the contribution, so they can lower their AGI. So if their AGI lower, so they may qualify for tax credit. We talk about all those earned income tax credit, child credit, the child dependent care credit. All those credit they may eligible more for those credits. So that's just something, and those benefit have associated with the contribution. Okay, here we talk about those Mike is not covered by the retirement plan. It's very simple. If you are not covered by a retirement plan at your workplace, all your contributions are tax deductible. So include your spouse contribution. You have to know the spouse is not working. If spouse working at the then have a workplace retirement, that's a totally different story. Okay, so here is the spouse is not working. Let's go to if you are covered, if you are covered by a retirement plan at your workplace. So this situation is complicated because IRS doesn't want you to get deduction. So this will be if you are contribution is deductible or not. It depends on your income amount. So your modified AGI for most people is your AGI. So just go to if you are preparing your tax return, so go to your form 1040 on the line 11. Look at the number is called adjusted gross income. So look at that number. What's the number? So if you so basically say your AGI, if you are married file jointly, you as a working spouse, if your AGI is less than $105,000, all your contributions is tax deductible. However, if your AGI is more than $125,000, your contribution is not tax deductible at all. So if it's between, then your contribution is partially deductible. There's calculation how to calculate So that's something. Here, I have a working spouse. So if you remember the last example, Mike is working and his wife is not working, right? In this situation, let's say, I'm gonna show you the example again. Just changes the scenario. Say Mike is working and covered by the workplace retirement. So when Mike is working, so Mike is called working spouse and covered by workplace retirement. So this is apply. This AGI limit is applied to the working spouse. How about Mike's wife is not working? So it's called non-working spouse. So you can see the AGI limit higher, which means it's more beneficial. So we're gonna see that example. Mike will end up not qualifying for deductible, and his wife is qualified for deductible. Then how about single or head of household? So your limit is very lower. It's much lower, right? So then basically say if you're a single person, you make less than $66,000, your contribution to the traditional IRA is fully tax deductible. If you make more than $76,000, your contribution to the traditional IRA is not tax deductible at all. What if you're married filing separately? This is a very, very bad choice for tax filing status. So if you're married, you're filing separately. So basically, if your income is more than $10,000, you're already not eligible to make any deductible contributions, or your contribution are not tax deductible. So I've been saying this over and over again. If you are married, you better choose file jointly, because married filing separately you're gonna pay much more taxes. You have less benefit to you. So that's just not something you want to choose when you, in term, for your tax filing status. Okay, let's just see the example again. In this example, I changed the situation. Say, well, Mike is still married, make $150,000, right? So now, before that example, he was not covered by his workplace retirement account. In this example, he is covered by the workplace retirement account, right? Then his wife still stay home, not working. Then they both under age 50. So don't misunderstand eligibility for make contribution and the eligibility between the deductibility. So Mike may still can make a contribution maximum $6,000 to his traditional IRA, but this $6,000 is not tax deductible. I say it again. Mike is eligible to make contribution, but his contribution is not tax deductible. So it's okay he make a contribution, but IRS said, well, your income is too high. We are not allow you to deduct tax on it. And so then if you cannot deduct the tax, then what is this contribution? This is called after-tax contribution. Like money you put in the Roth IRA is not tax deductible, but you still allowed to put in traditional IRA. I do not recommend anybody doing this. So if you are not eligible to make a deductible contribution, it's not beneficial for you to to make the contribution to traditional IRA. So it's after tax, then it's gonna be very, very complicated for in the future for you, because you're gonna have a pre-tax and after-tax money in your traditional IRA. Every time you take a distribution when you retire, you have to file additional form to track the after-tax amount in your account. So it's a pain in the neck. So I do not recommend that you do this. If you are not eligible for the deduction, you do not make the contribution. So that's just my recommendation. How about his wife? His wife can make a $6,000 contribution to her traditional IRA, and her contribution is tax deductible. As I said before, because for the non-working wife, they eligible for higher the limit, so which is more beneficial. So you can see they are married filed jointly. The income is $150,000 is less than the $198,000. So in this situation, the wife is eligible for deduction on the contribution. So I just want to mention that here. If you use the TurboTax or HR Block or whatever you use the tax prepare, I'm gonna tell you the thing is most of the time, they won't tell you is it tax deductible or not. Okay, so you will make the contribution. You allowed to make the contribution. The software may not deduct the tax on it. You don't know. So you with all other things, your tax is lower, higher, and so you not really know if this is you make the contribution is deductible or not. Most of the time, I'm just saying the software will not tell you. Then your tax preparer most of the time they don't understand this detail, so they won't tell you either. So you may end up have a after-tax contribution in your traditional IRA. Then you don't know because you are not eligible to deduction, but you are eligible for contribution. The software won't tell you, your tax preparer won't tell you. So you may end up have after-tax money in your traditional IRA. So that's something you need to pay attention to it. Okay. So that's just something. That's why you want to decide if you should make the contribution actually during this period from January to until the deadline, because then you can look at your income amount, right? Your AGI is that over this limit or below this limit, so you can make the decision here. So yes, so continue. So this is their marginal tax rate is not changing. It's 32%. However, the wife allow to make the deduction. So the tax saving is half, right? Compare last example. They still have a little benefit, still can lower the AGI by $6,000. Then still may qualify for more tax credit. That's just something keep in mind. So that's this example. Another thing I want to mention that many people make this mistake because there's a traditional IRA. We've been talking about traditional IRA. Traditional IRA, similar like your 401k, can deduct tax. Then there's another thing is called Roth IRA. It's a very beneficial account. So IRS will tell you your contribution to the traditional IRA and the Roth IRA. This limit is for both of them. Okay, so basically say your traditional IRA contribution plus Roth IRA contribution is less than $6,000 if you're younger than 50. So it's if you let's say you during the 2021, you made a $2,000 contribution to your Roth IRA. So now $6,000 minus $2,000, you only have a $4,000 left. So your traditional IRA only allow maximum $4,000 contribution because you used in your Roth IRA. So that's just the same thing. Your traditional IRA and the Roth IRA share the same limit. The total contribution in the both account cannot be more than $6,000 if you are younger than 50, $7,000 if you are older than 50. That's just the same thing I want to mention here. Okay, that's it. Thank you. You have a good day.